Hey everyone, welcome to an amazing interview. Today I have my friend Greg. Some of you know him. We interviewed Greg here on PPC Ian a while back. This man now is living off of distributions from dividend paying stocks, from passive income investments, and he is living the dream, so to speak. He went from working a job to retiring early full time off of passive income. And so we're really lucky to have Greg here today. He's going to share his story about what it was like to move from a job to living off of passive income. And he's going to share some of his strategies with the community as well about how he personally likes to invest. And so, Greg, I want to extend a warm welcome back to PPC Ian. Thank you for being here today.
I'm very happy to be here with us a second time.
And Greg, could you please tell the community just a little bit about yourself? For those that don't remember from the last interview, and by the way, I will link to that prior interview in the description in the pinned comment because all of you should refer back to it because it was a super interview.
I was a chemical operator for about 17 and a half years. And along that journey, when I started and once I started making a generous wage, I self-educated in investing. And along that journey, it went from just saving for traditional retirement to a genuine desire to leave the workforce early. And along that, the progress I made along the way is how I got to where I am today.
Well, Greg, that's amazing. And one thing I wanted to just share with the community before we get started is we are going to cover some stocks, some publicly traded entities, positions today. And just in terms of full disclosure, if a stock or an entity is mentioned, either I own it or Greg owns it or both of us own it. And so just in terms of full disclosure, I want to add that up front. And also in terms of a disclaimer before we go any further, anything that I say or Greg says today obviously is just sharing our personal journeys along the way in investing. And it's not investing advice. We're not professional investment advisors. And so, of course, anything mentioned today is just meant to be for entertainment purposes, informational purposes. And please do consult your own advisor before making any moves with your money or your finances, because we're going to be getting into some really interesting topics today, but it's really the journey that I've been through or Greg has been through that we're covering today. And so with all of that, I'm going to be looking down at my notes because there's a lot of questions today. First and foremost, I want to just extend a congratulations because we were just doing like a pre-meeting little talk here, and I was explaining to Greg how rare it is what he has accomplished. And so first and foremost, I want to illustrate just how excited I am for you and how amazing it is that you have achieved this early financial freedom through passive income.
Thank you.
Okay. And I want to get in first, kind of the storyline today. We're going to talk just about what it was like for Greg to reach this goal. And the first question I really have for Greg is just at a high level, what was it like? I know last we spoke, he was maybe about a year out from leaving his job. Now he's been into retirement for how many months has it been so far?
My last day of work was March 18th.
Okay, okay. And so it's been
I
a
actually
while.
pulled I actually pulled up the date. It was originally planned for June 1st of that year, but once you get your mind to something and you really get into that, I just had to go, and I did.
What was that like? What was it like on your first few days after retiring from work? And how did your life change in that process?
It was very empowering. It was very liberating, and I have felt no attachment. I felt no regrets. I felt no remorse. It felt honestly like the best decision I could possibly make. And I didn't really feel any different in that first week other than that feeling of liberation. I didn't really do anything other than just mind my own. And I did take advantage of the fact that I could go out and have lunch, catch up with some old friends. Actually, that very first Monday, I had lunch with people I hadn't seen in years. So already taken advantage of it. It's very relaxing, very liberating. And it just felt like, but other than that, I didn't have any anxiety. I didn't have any fear, no phobia, no, oh my gosh, did I just give up a biweekly paycheck that I could never get back none of that. Not even once, not even slightly.
That's really interesting. Did you prepare yourself mentally for making that move from working to retirement? Because I imagine a lot of people might naturally feel like, wow, this is a big change, or oh, I fear that I don't have that paycheck anymore. Did it go so smoothly for you because you had mentally prepared yourself, or is it more just the nature of how you are that it's you don't carry a lot of worry with you?
I'd say it was both. It was a combination of both. I think the fact was that, I mean, when I had announced it the year prior in the summer of 21, I don't think a lot of people took me seriously. And that turned into, it kept going on all the way up until my birthday of that year in October. And so many people had kept doubting me and assumed that I was being facetious or it was all an act or theatrics, that I just said, you know what? I'm going to make sure this isn't a joke. And I just started hoarding cash. I just stopped investing all my money. I stopped pulling money out of my paycheck. I had already had my 401k contribution off for a full year because I figured there was no point doing that anymore. And so I just hoarded cash. And I knew that when I did leave work, I would be able to cash out all my vacation time, which would give me paychecks beyond that. And then I think I ended up with 6 to 8 weeks of additional health insurance coverage and additional paychecks after I left. And just having that, there was no worry whatsoever. I think if there was any worry, it might have been that I would have had difficulty setting up my retirement accounts with Fidelity for taking distributions, but they have world-class customer service. And although there were a few things, there were a few realities I had to deal with that I hadn't anticipated. They just added maybe 5 to 10 more minutes of work when I needed money. And once I got that set up, it just flowed. So I think that was probably my only concern is, can I actually be able to take those 401k distributions? Because if that would have been an issue, then my whole system would have been at risk, but it wasn't. So, and there was no fear.
That's
Other than that.
nice.
Yeah.
That's really nice. And it was interesting to hear that so many people felt like, are you joking or are you being facetious here with your plans to retire? And maybe some of them were skeptics, but I think a lot of them maybe even were just couldn't comprehend what you're trying to do because it's so non-traditional. It's not what we're raised to believe in. And that's why I think it's so exciting to share your story here with others, that it is possible to retire early. And I thought your insight there was interesting because it made me remember back a little bit to some jobs where if you leave and you've accumulated a lot of paid time off, for example, that you don't use, that's extra money that gets cashed out there at the end. Is that
Yep.
kind of that's what you experienced? That's wonderful.
Yep. I consider that more float. I consider that more float in my liquid accounts that just allowed me to drip and reinvest everything all the way up into the point where I couldn't anymore. And that's what I did, which again gives you more bill paying power because of the way compounding works. So it all worked out beautifully.
That's
So
wonderful.
a lot of it was really planned. A lot of it was ad hoc. Let's see what happens. Whatever happens, I'll figure it out. So yeah, wouldn't have changed anything about that transition period.
That's so great. And I know you shared some things with me just on Instagram. It's wonderful to note that you also, it seems like you just left the workforce on a very positive vibe. Like everyone was supportive, and whether it was your friends, your coworkers,
Yeah.
your kind of the leaders at the company, and that's so exciting. I have a question. Just now that you are retired, you've been retired for a while. Are there? Can you describe to some of us, because we're kind of going through the journey and trying to understand what's it going to be like from a firsthand experience? Can you explain just some of the pros and cons, like of retiring early? What's your day like, and are there anything that was unexpected out of it all?
I would say the absolute biggest pro is the removal of a major stressor about having to deal with having a workforce where you had a team system where we're dealing with a lot of people not pulling their weight, which is in any work environment. That's not a knock against my specific prior work environment, but the removal of the alarm clock is what I tell people. Number one, because my prior situation was 5 o'clock alarms for almost half the year. And I was miserable. I mean, I adapted to it, but I never enjoyed it. And now I think I've only set my alarm once, and that was to take my dad to an airport. So once in over half a year. So that's the biggest benefit, because if I really have a bad night, or if I were to be sick or restless, I don't have to be punished the next day by still getting up and expected to perform the same duties. By far the biggest pro. On top of that is completely being able to make my own schedule. Now I have the freedom to, when you are scheduling appointments with places that are very busy, you have literally every weekday to do that. And I never have to work around a schedule like that. And it's also comes to when your friends or family want to do something, you no longer have that in the way. You can, if you choose to, engage with people every day of the week in a social recreational setting, if you want to, 5 out of 7 days. So by far, just the freedom. The only con I would say is there's sometimes you just might be, I know there's a few times I've struggled with, I hate to use the word boredom, because I have so many hobbies that it's never really like that. But you sometimes, especially coming into the winter here and the lack of sunshine, which I've really experienced weekly, I got into a very good habit in the summer of taking walks outside multiple times per day, and sometimes sitting out in the grass barefoot, reading, getting sunshine, grounding, exercise. And that was very stacked on top of the other things I was doing. That was a very healthy and recreational, cathartic experience. In the winter, I won't be able to do most of that. So that's kind of an unknown. I don't know how that'll be, but what I tell myself, it's still a better situation than what I had the prior winter, because I no longer have to drive to a job at 5:30 in the morning in 6 inches of snow and anything scary like that. So there's the con that I don't even know if I want to call that a con, because it's still better. I don't think I truly can say that there's a con yet. I know for some people it might be easy to get complacent or lazy with some habits, such as eating worse, eating more junk food, or day drinking, or doing things that are not healthy in the long run. But I eat less now. I don't go out for fast food anymore. In fact, I don't think I've had fast food maybe once in the past half a year, whereas before I was doing it every 2 weeks just because I felt like I deserved it. I don't day drink anymore. I don't drink during the week anymore. So I've let a lot of that go. So that's a net positive. Where a lot of people might be afraid that they would do more of that, I've actually made progress in those areas. So that's all a pro, is from my perspective.
That's really wonderful. And have you found just now that you are retired, there might be a little more time on your hands to prepare meals? Like, because I know sometimes for me at least, or for our family, if we're so busy, we're just like, you know what, there's no time to cook or wash all these dishes tonight, so we're just going to go to fast food, and we know it's not healthy, but we know we know honestly the price of fast food these days, it's not even a good deal anymore. It's so expensive. It's cheaper, much cheaper to eat at home, and healthier. But have you found you have more time now to prepare food, to eat more healthy, or to save money on food?
Absolutely. My grocery bill is way down. And whereas I actually had a friend teach me how to cook, specifically because now I have the time to do so. And if I want to prepare a simple dish, and I actually enjoy it, it's fun. It's because it's engaging your creative energies mentally and visually, putting all these foods together and having it turn out to be something that's that's enjoyable and healthy. And the cleanup is no big deal because it's my time. So that
Yeah.
was absolutely, it didn't happen right away. In fact, it was something I just engaged with in the fall, relatively recently, but I definitely took advantage of that opportunity. So yes, I do
Yeah.
have those time, and I could cook a casserole and make food for a whole week if I wanted to, and it's no big deal
Yeah.
because I just have that set up. But I do actually spend less
I,
on
I love
perishable.
this point because I've always had this hypothesis that people get concerned about living off of cash flow because they feel like we live in an inflationary world, and we do. But the point is, there are certain deflationary things that all of us could do in
Absolutely.
fire that could combat some of the, at least some of, partially at least, some of the inflation that exists around us. And one of us is just using some of that time to pursue passions like cooking and saving some time. And one of the things I picked up as well that I really resonated with me is this notion now, Greg, you're saying you have more time to meet with family members, with friends. And
recent example, I went with my mom to a ballet downtown for the first time,
oh,
something I
wow.
typically would not have done when I was working because I was always so tired on my off days. But she wanted me to go. She wanted the company, and I said yes. I didn't even have to really think about it. I said, you know what? Let's do it. Let's find out. Let's get some new experience, some experiential stimulus here. And I turned out I loved it. And I told her I would go back to any ballet she wanted. And that really made her day. So
That's
it's
so
just,
cool.
and I didn't feel like I was giving up anything
Yeah,
because it wasn't a day that I couldn't get back because I had the next day or the
that's right.
next day because all my days are weekends now. And that is a beautiful thing.
Now, on that note, I have a question about work. In leaving work, do you feel like anytime like you miss this the structure or the system or the people, or do you even feel sometimes like, boy, I know some of us sometimes feel like imposter syndrome, like, do we, like, how did this happen, or how did I end up here? You forget, sometimes you can even forget the struggles of the past. Do you ever feel any of that, or any like you miss it at all, or anything like that?
The structure, absolutely not. The people, yes, for sure. I mean, that is joking around with people. Because you know me, I with my sense of humor, I brought a liberating amount of theatrics and humor and creativity into the workplace. And that was missed by everyone because there are many people who have those qualities. And I've done my best to keep in touch with the people that I miss the most, although that's not always practical.
Yeah.
Um, they certainly miss me. I mean, uh, I was invited back 4 days after I left to be a contractor. They
Yeah.
wanted me to be a tutor on the job I had run prior. Offered me a LLC, I think it was, or something like that.
Wow.
4 days into retirement, I didn't even get a full week. So, of course, I said no, of course. But yeah, that was the people I missed for sure. But other than that, it was time to go.
Yeah.
I mean, without saying anything, it wasn't a good fit for me anymore. It
Yeah.
might have been at one point. The paychecks were generous, but it was not a good fit for me, and
Yeah.
I had to go. So imposter syndrome, I don't think
Yeah.
I've ever felt that once.
Okay.
It's not like, why me? How did I get here? I knew exactly how I got here because I grinded it out, and so
That's great. Yeah, and I think for those that don't know, Greg is on Instagram and he shares his portfolio there and a lot of humor and fun updates. And of course, I will link to that in the pin comment and the description below so you can track his progress there as well. But the reason I'm bringing that up is his progress on Instagram is living proof that he has in fact grinded it out. You can see all of the updates over the years, and it's been just fabulous following that trajectory. And what I would say as well is this man is living proof of how to do things the right way, because I'll tell you just from my personal experience, I've worked a lot of jobs over the years, and I've learned a lot of lessons the hard way. And one of the lessons I learned is one of the jobs I was at, it just wasn't the right fit for me. And I kind of left, I would say, on not the most graceful exit I could have. And it's something
Yeah.
to this day that bothers me. I think about
Yeah.
it from time to time, and it really bothers me that I didn't do things differently, even though maybe I was a little warranted to leave on that note. I just know in my heart I shouldn't have done that. But the reason I bring this up is Greg, I know things that maybe not everyone at home knows, because I speak with him on Instagram sometimes, and I just see I see what's going on, and he shares some stuff with me on Instagram. But what I would say is he left really on a world-class, kind of positive, graceful, respectful note. And I think that's probably what's made a big difference, and he did it right. And so I just wanted to underscore this point for people at home.
I mean, yeah, that's absolutely true. I never had the intention to do anything like that.
Yeah.
I mean, I had announced my intention a whole year prior by putting fire 2022 on my hard hat at work, exactly 1 year before. And I had nothing but support for everybody, because they knew, I was kind of like the company go-to guy when it came to stocks and investments and passive income and dividends and all that stuff. I even had the president of the company frequently coming up to me for ideas.
Yeah.
And so obviously people could have seen that coming. I mean, it wasn't just like I was saving money for some vapid reason. It was specifically for that. And I had nothing but support, and I never had to do it. I never made it seem like it was vindictive in any way. And I have nothing bad. I mean, I was never once mistreated there, or it wasn't any bullying or anything like that. It's just maturing,
Yeah.
realizing the type of person you want to be, realizing you want to be the steward of your own time, and that people change. And I had changed to the point where it wasn't what I wanted to do with my life. So there was never once a thought for me to do anything other than exit gracefully and professionally.
Yep. And
There's no desire to be petty.
This is exactly why I wanted Greg on the channel here, because not only did he pursue fire and achieve the dream, but he did it the right way. And so I think that's really, really commendable. One thing I want to do now, we've gone through some questions. So we're kind of, this first segment of the video, just what it was like, what he did. Next, what I want to get into is, a lot of you at home are probably thinking, well, how could I do this? Or how did he do it? So at least I could think about different options and strategies. And I know here on this channel, I talk a lot about core stocks. And here's one of them, Starbucks. I'm always talking about core stocks and blue chip names, and that's one way to go about it. That's one strategy for fire. But I would say, when we were brainstorming this interview and how to go about this interview, Greg was very particular. Ian, we don't just want to say dividends. We want to talk about passive income, and we want to talk about distributions, because a lot of what Greg has done is a little bit different than what I talk about day to day. And that's one of the reasons I want him here, because he provides a different perspective for the community other than mine. And anyway, on that note, I would be really curious, Greg, if you could give just a high-level summary of what your strategy is all about, and how it might differ from people like me, who are more like Peter Lynch, or more classical kind of blue chip stock investors.
So my strategy is I think this is a phrase from Kevin O'Leary. He might have coined this, or someone else might have, but it's about every dollar is a soldier, and you're about maximizing your army of dollar bills. And so when you have a 4-bucket strategy like I do, where you have an HSA, a 401k, a Roth IRA, and a taxable, you have to treat all the dollars in those accounts like they're their own entities. And when you send them out to get the currency and bring it back to you, you have to do that respecting where they came from. And so I've had to slowly work on optimizing my accounts, because I left my job very 401k heavy. About 50% of my total assets were in a 401k. Not the most ideal situation for FIRE. In fact, you might not see many people do that. And if I could go back in time, this is in the theory crafting into opportunity cost and math. I don't know if I would have done it the same, but FIRE also wasn't really a thing back in the day when I was maxing out those accounts. It just did it. But that was the reality I created. I couldn't undo that reality. So I had to think, how can I maximize this reality? And so in doing so, I had to it came to the point where I said to myself, I cannot leave with a 401k full of blue chips like Pepsi, P&G, and McDonald's and still pay my bills, because you lose the qualified dividend benefit completely. Everything's treated as income, regular income. In addition, I have to offset the 10% tariff penalty for not being 65. And I knew all that. And so I've been slowly optimizing my army of dollar bills ever since I left. I didn't do it right away because I didn't know. It's one of those things. I said I'd deal with it when I got there. And I've been slowly converting a lot of those more conservative growth names where you're investing more for income 10 years from now than income today. I've had to convert a lot of those into current income, where you're not hoping for any capital appreciation, or may not even be hoping for ever a distribution hike. You might just be going straight for a 10 to 12% yield, and you're hoping that just stays the way it is into perpetuity. And if so, there's your return right there. I've had to convert a good amount of my retirement to that while still keeping as many of the blue chips as I want to. I haven't got to the point where I've had to, let's say, liquidate my McDonald's position completely, or liquidate my Pepsi. And I don't want to. I'm going to try to make it work. I would sell things that I didn't have any cognitive attachment to, like my pharmaceutical holdings. I nerfed those by very large amounts. I liquidated one completely for a lot of reasons above and beyond just money. And then other good ones I slashed in half, because I just didn't, it wasn't a desire for me to research pipelines anymore, or just have them. I had lost enthusiasm, and it worked out for me, because in this market, a lot of those defensive stocks and entities are still trading near their all-time highs.
Yeah.
Like I was trimming Merck and Amgen when they were popping at all-time highs.
Yeah.
Though everything else, not everything, a lot of other things were in the sewer and the gutter. And here I have these entities trading at multi-year highs. It was a no-brainer for me. The opportunity cost to hold them was too high. So I would pull money out every day and start buying things, whether some mortgage REITs or closed-end funds or BDCs. And I would do that. I would do it little bits at a time. And then I'd look at it and let it settle. And then I'd see how much more bill paying power I would have going forward. And I'm still in the process of adapting, and I will continue to do so until not only can I offset all taxes and everything like that, that I also am able to reinvest more than I currently am. And I've worked out a system now. The system I have now is to where I can preserve my Roth IRA money, and I reinvest all that, because that is my high priority. My personal accounts are priority. I want to preserve that money as long as I can. Whereas my company account is kind of like my burner account. I use that to try to cover as many expenses as I can, because it's still, I don't treat it like it's a person. It still has the company name attached to it. It's still not mine. I still would have to deal with the consequences if that plan were ever changed on their end, which I don't foresee it ever to be. It would put me in a jam. So because of that, it's going to be my main account for bill paying power. And because that's the reality that I'm creating and accepting, I've had to redo my holdings. So I do still have, the Peter Lynch thing is still great. And I still am very passionate about owning wide moat growth stocks with high returns on invested capital. I still own the Johnson and Johnsons of the world, Pepsi, McDonald's, and a few others, but they're just for what I wanted, what I needed, and to be able to embrace a lean fire system at the age I am, they won't get me there.
No.
They're just not cheap in this environment. Maybe one thing, if credit was expensive and blue chips were trading at 10 times earnings, if Johnson & Johnson had a 5% yield, we wouldn't be having this conversation.
That's right.
But that's not the reality we have. You have a lot of those SWAN, sleep well at night entities are still trading at premium valuations in this market.
Oh, they sure are. Yeah.
And they're still good to have because they do have the, they can preserve the purchasing power through raising their prices through inflation. We've seen that very recently with McDonald's, who blew us away with, I would have never expected a 10% raise from a, and that's the thing. That's why I want to have a hybrid. I want to hold on to the entities that I choose to hold on to, but then I also want to buy some things where I'm not expecting anything other than the distribution. Another cool thing is that a lot of the entities that I have been buying on the latter part, which are credit or business development companies, things that have a lot of floating rate exposure, are actually being able to raise their distributions even higher than any blue chip could. Like some of the, I've been getting 10% raises from certain things that are stacked on top a already 10 or 11% yield. Now that's a very powerful phenomenon. Now, obviously that is not going to be nearly as consistent as a 6, 7, 8, 9, 10% raise from Procter & Gamble, McDonald's. That's a fact. And some of that they might have to give back and pull back on if rates were to ever come down. That's a reality that I'm comfortable with. But it's just that it's worked out. I've made a joke, not so much a joke, a comment recently to a lot of people that this environment has been one of the best environments for what I want that I've ever seen. I've never seen credit this cheap. I've never seen things that are not in what I believe in risk of detrimental cuts this cheap. I can't remember, maybe in 2020, but that was like an ephemeral blip. It was over as soon as the Fed started printing money. We never got to buy the dips. If you look at the chart in 2020, it was and then V shape. I don't think we're getting that V shape now because, you know, with quantitative tightening and interest rate hikes, we're not going to get that bounce back. So credit has been on sale. I believe it will continue to be on sale. And the comment I was referring to is I tell people that I almost wish I were still working, because if I were still getting that biweekly paycheck, I would be soaking up a lot of these entities with these double-digit, relatively safe distributions as much as I could. It would be like hungry hippo with the marbles. I never had that opportunity when I was, it's kind of just one of those funny things. But because I don't have that, I'm not bringing any new money into the system. I have to take existing money and move it around. And it's just a beautiful thing that the market itself has worked out to give me what I need. It's almost like the law of attraction. I don't really believe in that, but it's like the universe shapes itself around what you think. I don't believe that in capacity, but if I were to believe it, that would almost explain what is happening right now.
This is a very interesting. There's a lot to unpack. I've just been taking a few notes. I think the first note I took is you basically, being someone who is retired, look at the dollars you earned as soldiers, and you need to get as much out of each dollar right now as you can. And with a company like, say, Starbucks or McDonald's or one of those, they're just not fighting hard enough for you right now. Maybe they would be in 10 or 20 years.
That is exactly
from
right.
a yield on cost standpoint. But the fact of the matter is you don't want to wait 20 years. You're already in retirement. And so you're finding the entities that can fight the hardest for the money that you have to invest now. And so that was a real interesting takeaway. Another one I had was a lot of us, myself included, kind of feel like there's a lack of value right now. I bet you poll most of people watching on this community, because most of them are used to just hearing me talk about blue chips. we feel right now like there's not a lot of value, and I think it's only natural. We look at a company like McDonald's and it just hit an all-time high. We look at a company like Starbucks, it's recovering, it's at like $96 again or something. I haven't looked at it
I think
today.
that one at least is a little bit from
There's
what
a
I,
little, it's still a little down, but
yeah,
but it's trading at a PE in the 30s, and
right.
so the blue chips, PepsiCo is a good example. It's,
Yep.
it's trading at a PE, I don't know, about 26 or so, and
Yeah.
it's near all-time highs.
Yep.
So we look at that and we're like, boy, where's the value? But you're coming at this from a completely different angle, and you're saying, Ian, you know what? I'm excited because I'm seeing value, because what I invest in right now, it's an interesting market because interest rates are higher, and the entities I invest in, they're benefiting from this. It's something,
Yep.
it's a bull market or a good cycle, if you will, for these types of entities that haven't seen higher interest rates for a very long time. And
Yep.
so this is just kind of flips everything around, and it shows us, all of us listening to Greg right now, how we might believe in one reality, but there are other realities out there that maybe we've not taken a look at. And so
Yeah.
I would be curious. This is fascinating to me. You were mentioning like mREITs,
Yep.
closed-end funds,
Yep.
BDCs. I don't know too much about any of these things. I would be curious. I'll tell you what I know of them is I look at something like that and I just feel, boy, that's probably too risky for me. And so I would just would love to understand what these entities are all about for those who are watching that don't even know about them. And two, how do you get comfortable with the risk associated, or maybe you're able to navigate these markets in a way where you become comfortable with what you're investing into, a standpoint of feeling that boy, it really doesn't carry all as much risk as an outsider like myself might think that it does.
Yeah. It's so it would be very similar to how you would look. It's not too radically different than how you would evaluate a traditional stock. Like you might look at Starbucks and say, let's see how they've grown over 10 years. And then you try to extrapolate from that where they might go in the future. Obviously, you're going to moderate a little bit because the law of large numbers, the bigger companies get, they can't grow for 15% into perpetuity, but at least you have a frame of reference. And so when it comes to other entities where things like PE ratios and return on invested capital are not metrics that are appropriate, you can go back, you can check something, you can check a credit fund's distribution history. Mm-hmm. And if I've seen evidence that something has paid a stable distribution for a decade, I can make a probability assessment that it might be able to do so for another decade. Even more so if they're able to reinvest new income securities at higher levels than they were prior. Or I look at how did such an entity handle itself during the Great Recession. Mm-hmm. And if I see evidence that was able to maintain its distribution, or let's say maybe 75% of its distribution, because you can be a little bit more forgiving. When you have something that pays 13% and it gets cut to maybe 9 or 10, that's hardly the same as when Disney just suspends their dividend completely.
Yeah.
That's actually kind of common for a lot of those entities with floating rates and some BDCs to see a 5% raise one year and then a 7% raise the next year, and then maybe an 8% cut the next year, but then it's back. Over time, you have either a static or slightly increasing distribution, but you can be more forgiving because if you're already getting your 9, 10, 11%, you're already getting what the stock market as an aggregate has returned over 100 years. So the opportunity cost, you're not giving up anything too significant. In fact, again, when we're talking about a lot of these blue chips at their current prices, they're not priced to give double-digit returns because the starting yields are too low for their growth rates. You know, with P&G, if you have a 2.5% yield now and you only believe it's going to grow 5 to 6% a year, you're not even getting to 10 or 11. And if I can buy 10, 11, 12 outright, it's a no-brainer for me, especially in an account where there's no tax benefit of having a qualified dividend. So it's the same in that sense that I want to look at the fund's history. And the thing about closed-end funds and business development companies, the sectors, the concepts as a whole are perceived as often esoteric or risky
Yeah,
or not even worth. But like
that's right.
anything else, there's going to be the ones that I would never touch with your money. And then there's going to be the blue chip versions of those. And that statement is a reality. There are almost universally recognized blue chips in the business development company space. So it's very easy for me, after spending the hours of research that I have, because I have the time to do so, to understand what those entities are and to focus on them exclusively, even if they don't give me the highest yields. Like I will buy a blue chip BDC like Ares Capital Management, ARCC, with a 9% yield over something, a lower tier BDC that has more money tied up in lower quality companies with a 13% yield any day. I'm still leaning for quality. So in that sense, it's still that Peter Lynch-esque mentality of finding quality. You just have to know what quality is in that sphere. And with credit funds, it's a simple measure for me of sticking with what I believe to be the best management on the planet. And companies like Cohen and Steers for real estate, PIMCO for a lot of fixed income. Ares Management, again, has also floating rate funds and commercial real estate funds that are considered top tier. So once I limit myself to sticking with already what's universally recognized to be the best in that world, it makes it so much easier, because then I don't have to sit there and research every one or even look at the world of closed-end funds where 1,000 of them might be garbage. I just can find the 50 that are considered to be best in class and then pick 5 or 6 and stack them on top the companies I already own, and it all works out. Now, that doesn't mean that things can't happen. There's always a risk of exogenous factors. There's always a risk of a distribution cut. But the way you can hedge against that is you don't have to go all in on any one. It's like, then this is one way that it's very different from what you do, where you have your core holdings. You want to be overweight J&J, you want to be overweight Starbucks, you want that, and you want to be able to pass that on, through generations. Whereas income funds, you don't need to fall in love with something. You can find 6 and you can equal weight those 6, and then whatever happens. And when you bring new money in, one might have a cut, and one could have a cut, and one could also have a raise well within the same month, because they all have different allocations to either things like residential mortgages, floating rate securities, collateralized loan obligations, and emerging market debt. Those are just examples. There's way more in the credit world. There's way more than I can even remember. But all the different funds have different allocations, and there's no reason, especially in a world where transaction fees are free, there's no reason a person can't pick 6, 7, 8 of these entities and throw dollar cost average, buy $500 here, buy 1,000 here. You don't have to have a core. You can. I do have some that are core and favorites for a reason, but you don't have to ever find a one and done. Okay. And I think once you accept that mentality, it feels a lot less risky, because you're not putting all your eggs. Now, that doesn't protect you if there's a massive exogenous, something happens that would bring down everything. You're going to go down more likely than not. But again, you can look back. I can look at a BDC like Main Street Capital, which is probably my second favorite, and look at the Great Recession, and they were still able to raise their distribution all through that period. And if I believe, which I do, that whatever economic slowdown we may have is not going to be nearly as severe, it would be more what we call a cyclical recession compared to a balance sheet recession that we had back then. If it survived then, I can make a probability assessment that it'll survive now. And that's how I feel more comfortable with that risk tolerance. On top of, like I said, not just cherry picking or not just going all in on one. I want to have 4 or 5. I have 5 BDCs. I have 4 credit funds, floating rate funds. I have 1 CLO exclusive fund. I have 3 mortgage REITs. And so they all complement each other. And I can also make it less risky for myself by just keeping them. I call them my ancillary holdings. If anyone were to look at my spreadsheet, you would see the mortgage REITs and the credit funds kind of hanging out at the bottom. And then you see the things, the blue chips like Microsoft and Enterprise Products Partners, my favorite master limited partnership by far, and Johnson & Johnson and P&G and Pepsi and Enbridge. They all still hold the significant part of my assets. So I kind of stack them on. And the beautiful thing about a 12, a 10, 11, 12, 13% paying an entity, you don't need to buy a whole lot to have a very powerful bill paying.
That's right.
Bill paying effect. Whereas if you want to retire, if you want to go fire off J&J, you darn near need to be a millionaire.
Yeah, absolutely you do. And and if you're not, you need to put enough money into it and wait long enough for it to get to those lofty levels. I wanted to go back and just unpack something that Greg said that really resonated with me. He mentioned that the yields, the starting yields at some of the blue chips right now are pretty low. And the growth rates, quite frankly, at some of them like P&G, which I own, are a little lower. That it would take a long time to basically even reach equilibrium with some of these other investment opportunities like the closed-end funds, the BDCs that Greg is investing in. And I would say that resonated with me a bit in the sense that I just run an analysis recently that some of you have seen where I do invest in treasury bonds. And I found that the inflection point, even between government-backed U.S. Treasury bonds yielding in the 4.5% range versus a dividend stock like a McDonald's or a classical stock like that, I found that the inflection point where the dividend stock would kind of catch up with the Treasury, it would take, good, say, 6 to 8 years at this point. And so the fact of the matter is there's different strategies within passive income investing, and one is a yield on cost strategy. But when you have these stocks that can offer a lot of yield on cost trading at premium levels, it could take, and you're in a higher interest rate environment like we're in now, it can take more years for that strategy to quote unquote catch up. It doesn't mean it's a bad strategy, but it just means it's a strategy that requires a lot more time and waiting, and may not make as much sense for immediate cash flow retirement right now. And so I thought that was fascinating. And obviously, treasury bonds are pretty conservative. If Greg in his own analysis is comparing McDonald's to a closed-end fund yielding, say, 9%, that inflection point could take even longer. It might be, 10 years, 15 years. It could be even longer. And so obviously, I think a lot of investors, would they prefer to have a 15% yield on cost on McDonald's versus a closed-end fund? Maybe they would, but it's more years involved for the dividend increases to reach that inflection point. One thing, that's just my own commentary. I'm not saying necessarily Greg agrees or disagrees with that. It's just something that resonated with me as he was speaking.
I just had one comment about when you were comparing a yield on cost versus high income. One of the things that changed my perspective was when I read a book, The Income Factory by Stephen Bavaria, and he made a very coherent point that math is math, that buying a dividend growth stock that has a total return of 10%, 2% yield and 8% growth should be the same as, this is not counting taxes, right? Which is a separate issue. But if you, when you're young, you buy an entity that pays 10% and it pays 10% into perpetuity and you reinvest it all, that's not really a difference. You get your kind of yield on cost based on your original principal in the same way. And reading that really changed my mind that, you can still buy high yield even if you're not close to retirement, because if you're dripping that and putting that 10% a year back in, that can be every bit as powerful as the blue chip growth companies that we were talking about prior. So that's just one anecdote. That's one thing that never occurred to me.
I think this is an important point you're making that I want to be highlighted on this channel, because you all know me. I've been doing videos here, over 350 something odd videos a lot of videos, and most of them are about blue chips. And I have my own biases. I think it's important as an investor to do what feels comfortable to the individual person, and there's not one right strategy. But what feels comfortable to me is something like this. I know what it is. I can sleep with well at night because I know what it is. But I think where Greg is headed here is what the author of The Income Factory was saying is there's nothing necessary. Maybe I think it's inherently better, and I'll defend that till the end of time, because I fall in love with these blue chips.
And that is value. It's subjective. It was far better for you. Absolutely, is subjective. His point is just from math. Yes. Math is math. And even when I read his articles on Stephen Bavaria, on Seeking Alpha, because he is an author there, he gets all these comments by people who don't quite get that, or come at him making straw man attacks against it. And he just has to remind him, look, math is math. Yeah. If you have a 10% entity and you put it all back in, you're getting the same effect as a 10% total return that's split. Yeah. It's just one, you can make the case, you know what you're getting, you don't have to wait. So he would definitely be biased. He'd say 10% is superior because you know you're getting, whereas you think of all the number of times that our favorite core companies have not lived up to the math that we were expecting. Sometimes they overshoot. Yeah. But there's generally less uncertainty in a lot of those credit funds, especially because credit itself is less risky, because you just need the loans to be repaid. That's it. You don't care if they take over the world or smash earnings. Unlike owning a business, all they just need to do is pay back their debt.
That's right.
So it's like it's the logic that if you can get an equity return, if you can get an equity-esque return with a credit bet, you've already got 2 steps ahead.
And this flips a lot around for myself and probably a lot of folks watching, because we've been raised, I guess, in a way to believe in the core stocks. But what Greg is proposing here is a argument that, hey, there are other investments out there that may be superior, especially in the market we're in now, because you have the 10% yield in hand, versus with McDonald's, you're waiting, say, 10 years to have that return. And we don't know what the next 10 years hold. Could McDonald's face a lawsuit that postpones dividend increases? Could demand
like 3M, right? A perfect example, 3M. If you had asked me years ago, I would have said 3M to perpetuity. You go back a decade or whatever, and you look at their growth streak, but things happen, and you just don't have that. Again, that goes back to those. I would consider that an exogenous risk. You don't have those in diversified credit entities, because they might have 1,000 different loans in that portfolio with 5 different managers, and you're buying 6 or 7 of them. So if you extrapolate that, that's how well protected you are when you get into those things. It would take like a depression level event to be a problem. So it's another thing. It was just like you brought it with the litigation lawsuits. That was another thing I thought of when I said to myself, I just don't want to be tethered to so many individual entities when I can not only match their performance, but probably do better not having that risk. For me, that was a no-brainer. And that's why I've adopted the system that I have.
Now, one other nuance I'll add on credit is, generally speaking, if a company does go bankrupt, the credit holders, the debt holders are higher up in priority.
Absolutely.
Against the assets of the company, as compared to equity holders or common stockholders. So I guess that's another way of looking at it as well. I would be curious on, so we're talking about credit here. Have you looked at the entities that you're investing in and understood like some of the loans they've made? Like, are they being made to small businesses, medium sized, larger? Like, is there a different philosophy or a different means of analyzing these entities to get comfortable with the types of loans that they're making?
I do that, not to the same degree that you do when you break down the balance sheets. Uh, you can typically go on the company itself website and look at their loan portfolio and see where the money's coming from. But beyond that, there's really not a need to look up specific names. Or now with business development companies, their websites are very shareholder friendly, just like real estate trusts, because all those entities specifically exist. It's a tax structure the government created just to pay you money. That's why they exist. They get tax benefits, and then they have to pay out 90% of their earnings. It's awesome.
Yeah.
And so their websites are both aesthetically and informationally designed to help you. So you can go on there and you can see, I could see, like with a business development company, I could see if they're investing in things that I think will change the future. If there's, I tend to prefer tech and software heavy BDCs because emerging technologies, is the future. And unlike a lot of the stocks in those sectors, they don't get bid off to the moon because there was a Reddit thread. You don't have to deal with any. You're just betting on the fact that they will exist and continue to exist. So I can choose to focus on those type of companies that have loans to businesses that I believe have a future, and I can avoid the ones that might say overweight old economy like industrial or energy. Although we know in this environment, it's not a bad thing to have money lent out to energy companies because we need that now more than ever. Big surprise there.
Yeah.
So, I mean, you do have, I would say I don't sit there and spend hours looking at them. I might spend 15 minutes. Like I recently went on the PIMCO website to read the portfolio differences between the three I own, PTY, PDI, and PDO. But that was after I already had them. I never worried about that once because, one, I was relying on the testimony of people who I trusted, which we all do to a certain degree. I mean, very few of us, maybe you, do wholly organic research. Most of us, especially when it comes to these funds, you're reading someone who you're learning from someone who knows more than you do. That's why we read books, right? Very few of us are starting from zero. So for me, it's starting with the history of the fund, the history of the distribution history. Is it reliable? How will this environment affect it relative to everything in that macrocosm, in that specific sector? And then I usually make my moves there. And then later on, I might get the urge to try to understand the portfolio. But to me, that's not necessary to understand why they exist. It's not. Credit is so much more complicated. Like I've read multiple articles on CLOs and collateralized loan obligations, which unfortunately a lot of people conflate erroneously with CDOs, which were responsible for the last financial crisis, where CLOs came through just fine mostly. And then reading about them is very complicated. And there's also the equity and debt portions of specific debt entities. So when you get all that, it can be very complicated. And that could be a turnoff to some people, but not to me, because again, that's why I subscribe to Seeking Alpha. So I can rely on the testimony of people who know better and then decide for myself if I'm comfortable with that risk. And then I weight it in my portfolio stacked against all the other things I'm comfortable with, and it all works out. Okay. So there's definitely less, I put much less emphasis in understanding the portfolio constituents and quality, as much as looking at, does it have a stoic distribution history? Yeah. Is this very well respected management in the field? Yeah. Are people who I respect and trust putting way more dollars into these entities that I am? You factor all that in, and then you're making an inductive, inference from all that. Again, it goes back to that probability assessment. If I believe all this, then I have a reasonable, then for me, I think it's okay for me to put what is relatively small dollars compared to the people who run these portfolios. If they're doing it with their own, and then spreading that out and picking multiple, all that together makes everything feel so much better.
Hey everyone, I really hope you enjoyed that video today. That is actually part 1 of a 2-part series interview with Greg. We actually have about 2 hours of video interview, so I thought I would split it into 2 videos. So please make sure to subscribe to this channel, as I'm going to be working on the next segment to publish here really soon. I want to share my heartfelt congratulations with Greg. Please go ahead and share in the comments below as well your congratulations with Greg. He's one of us. He's part of the dividend, the passive income investing community, and he did it. He went ahead and he reached fire at a young age. And so, Greg, what an accomplishment. Congratulations. Thank you for sharing your unique perspective here on PPC Ian. Thank you for sharing your story. I'm so excited about the second segment of this video that will be published soon. So again, stay tuned for that. Before we leave today, I want to share a disclosure and a disclaimer. And so in terms of full disclosure, I'm going to list all of the stocks and entities mentioned today. These are entities that either I own, Greg owns, or both of us may own. And so in terms of full disclosure, here are the stocks and the entities. I have Starbucks, ticker SBUX. I have PepsiCo, ticker PEP. Procter & Gamble, ticker PG. I have McDonald's, MCD. Johnson & Johnson, ticker J&J. I have 3M, ticker MMM. I also have Merck, ticker MRK, Amgen, AMGN. I have Microsoft, ticker MSFT. I have Enterprise Products Partners, EPD. I have Enbridge, ticker ENB. I also have Ares Capital Corporation, ARCC. I have Main Street Capital, MAIN. I have the PIMCO Corporate and Income Opportunity Fund, which is ticker PTY. I have the PIMCO Dynamic Income Fund, which is ticker PDI. I have the PIMCO Dynamic Income Opportunities Fund, which is ticker PDO. And I also have Treasury bonds. Those are all the positions that were discussed today that either I own, Greg owns, or both of us may own. Also, this disclaimer that I'm going to provide right now applies to both myself and to the presenter, Greg, the guest presenter today as well. In terms of a disclaimer, today's video is not investment advice. We're not licensed investment advisors here. This video is just meant to be for fun and entertainment. Before you go out and invest in the stock market, the bond market, any kind of financial markets, please make sure to contact your licensed financial advisor. Greg and I today were just sharing our personal journeys for fun and entertainment. It's possible to lose money in the stock market, and so it's important to go ahead and make sure you consult with your own licensed professional before making any financial moves. This video is just for entertainment and informational purposes. I really appreciate you all tuning in today. I cannot wait to share part 2 of this video interview with the legend that is Greg. Thank you again, Greg. I will see you all in the next video.